I was able to drag my good friend, Linda Raschke. And I've known Linda since probably, I don't know, 2002, maybe 2003. She and her husband, Damon. Damon's going to be our guest speaker tomorrow. And I was able to get them here to speak, and they've been around for a long time. They have a lot of stories to tell. And she also has is in Jack Swagger's book, New Market Wizards. So when we're done tonight, if you'll come back inside, there's a copy in there for you. That is a copy for you. Without further ado, I'd like to introduce Linda Raschke.
Alrighty, so first of all, can everybody hear me okay? Because I know it's a little bit windy out here. Yeah? Alrighty. I want to thank Jeanette for putting this on. I don't think people quite recognize just how much work these little conferences are to put on. There's a lot of moving parts and stuff, so shout out to her, and I know you guys are going to have a terrific time over the next 2 days, especially since it's in the 80s in Chicago. You can't go wrong with that. Yay. So she asked me to come and speak, and she told me it was going to be outdoors and everybody was going to be drinking, so I thought, well, man, I certainly can't talk about anything too technical in that case, you know, and I figure you guys are going to get a dose of that over the next 2 days. So just to tell you a little bit about myself, I started trading in '81 and pretty much managed money up to about 3 years ago when I retired as a CTA and a CPO, and at that time I thought, well, let me just pull back a little bit because this is all I've been doing my entire life, and I wanted to learn how to ride a perfect circle on my horse. Okay, 30 years I've been trying to ride a perfect circle on my horse. It's not easy, and I got really bored after 3 months and went back to sitting in front of my screens. And one of the projects that I had for about 10 years, okay, was I had outlined about 5 or 6 different books that I wanted to write, a technical manual. I wanted to rewrite Taylor's trading technique and things like that. And Jeanette's waving her thumb at me. Is this better? Oh, I don't know, whatever. Alrighty. So at any rate, the long and short of it is that I made a bet with my daughter, who's doing her master's recital in vocal performance December 22nd, that if she got her rear in gear and did that I would have a book written for her. And it really turned out to be totally non-technical. It started to be a little bit of a catalog of some of my stories and experiences over the years, in particular, people that influenced me or lessons that I learned. And I would not be here today if I did not have such fortunate opportunity to have some amazing mentors and colleagues along the way. So when I started writing this, 2 themes started jumping out at me, and the first was, each person that I went along taught me something valuable, just like a little one-line type of thing that could be presented to you, and I know that everybody will go, yep, I know that, it's good to hear it verbalized by somebody else. And then the other thing was just how many outliers there are in this business, in every way, shape, and form you can never imagine. And that's truly the powerful thing about the markets, is that most humans like to think in terms of linear, algebra, geometry, solvable equations, probability models, normal distribution with statistics, and so forth. And all along my journey in the markets, it's always been a case of like, whatever can go wrong will go wrong right when you don't need it to go wrong. And you know the old saying, Murphy's Law. Murphy said that O'Shaughnessy's called O'Shaughnessy's Law. O'Shaughnessy said that Murphy was an optimist. Okay. So I thought I would catalog a few of the stepping stones for me along the way, starting off with the very first story that I heard when I went down to the trading floor in 1981. It was the Pacific Coast Stock Exchange, and the Pacific Coast Stock Exchange was originally founded in 1888. And then it wasn't until the 1970s that they introduced equity options. Chicago was the first, and then San Francisco was the second. And that's where I started off, originally doing arbitrage in the equity options, and it took it from there. So the first story that I heard when I was down there was called Trading Sardines, and this is what I actually was going to call the book. So I'm just going to kind of quickly detail this to you because a man was walking near the wharf down in San Francisco. How many of you have been down at the wharf in San Francisco? It's a very active, vibrant type of place. And it's where the fishing boats come in and they drop off their crabs. And he heard a big commotion out there. And he's like, there was a crowd frantically waving their arms. He's like, what's all the commotion about? So he drew closer to see what the fuss was. And he found that a crowd was bidding on a can of rare sardines. And all the noise and uproar, he quickly jumped in there too, and he was bidding as well. And before he knew it, he was the winner of this rare can of sardines. You know the fever that auctions get you caught up in there, right? So imagine his elation. He took this can of sardines to his wife, and he said, I just got this rare can of sardines, and we're going to sit down and have the most amazing meal, thinking it's like Russian caviar or something. So they opened up the can of sardines, and wouldn't you know it, they were rotten. So he's like, so he goes down to the wharf the next day. There's nobody there, but he finds an old fisherman sitting along the side of the dock, and he says, I just got ripped off. I bought this rare can of sardines and they're rotten. And the guy looked at me and says, you fool, those were trading sardines. They're not eating sardines. And so the moral of the story is that don't place valuations on the things that you trade. And that's the number one mistake that I see people make, is they think that they can value the stock or the product or the market they're trading. And you can't do that. It's much more abstract than that. It's definitely a game. So I originally had a backer that backed me on the floor of the exchange. This was like in 1982. And I'd be chagrined to tell you the name of the company that I founded because I was the general partner. He was the limited partner, and it was called Pyramid Trading Company. No joke. And it was because I had a little cube, a little key change that had a Rubik's Cube type thing on it in the shape of a pyramid, and like, you don't do that with a financial company. And needless to say, I had a first couple months of total glory, making tons of money, and then I got caught up in a takeover stock, City Service, where I blew out and was in business no longer. And that took me about 5 years to pay off that debt. So I was an indentured servant for the next 5 years to my clearing firm. So the second thing is, be really, really careful if you make money when you start off trading, okay? It leads to overconfidence, you underestimate the risk, and so forth and so forth. But I had a really good mentor. His name was Jerry Watson, and he had originally been a mathematician and had been with a brokerage firm, one of the first to get a seat on the exchange. I was sort of copying what he was doing, and he just didn't do it as big as I did it, which was, my mistake. But one of the things that he taught me was keeping the market internals by hand, which I've done for the last 35 years. I log the 10-day moving average of the trend, the 10-day moving average of the breadth, several, the put-call ratio every day, some of these statistics. And he also had a charting service that he got, because we didn't have charts or personal computers back in those days, called Security Market Research. And two other notable people that also got this. I know Marty Schwartz got those charts, and there was one other person too that people would know. But anyway, we would get these charts every day. We would update them by hand, plot this little oscillator, which you had to call up at night, and I did that for about the next 12 years, and it was really instrumental into developing a feel, actually doing things by hand. And they say that when you are doing work by hand, it actually goes to a different part of your brain, okay? Which is, nowadays it's so easy with the computers and the spreadsheets and the computing power and so forth. We manipulate data in a much different way. But doing things by hand, for me, I think really made a difference in the long run. So now it's like 1982, and it was the very first year that the S&Ps were listed. And I remember we'd all sit upstairs at the clearing firm, because truly it was really boring. You'd go down for the first hour, and everything would open up, and you'd make some options trades and so forth, and then everybody would kind of go upstairs. And I remember everybody's like, hey, this new contract, da da da. And in those days, you had to place your orders through the phone. We'd call down to our clerk, Rick, hey, Rick, buy me X number of shares of stock, execute the futures and so forth. And so I can honestly say that I traded a one lot on the very first day that the S&Ps were open, and I think I made 10 cents on it. In those days, it was the big contract, so okay, like the equivalent of 5 E-minis, but I'll tell you that the S&Ps were below 300 back in those days, and when I first started on the floor, the Dow was below 1,000. It had never hit 1,000, and that was for about the first year that I was trading, so a little bit of a little thing there. As an aside, it was kind of interesting when I got blown out in city service. It was by selling these straddles on the stock. The stock at the time was trading around 32, and I was selling the 40 level straddles, right? You'd think that if you're selling 40 level straddles for like $8, and the stock's 32, and they expire in 2 days, I mean, come on, isn't that a slam dunk, right? Well, never, ever, ever say that, because the day before expiration, the stock opened up at 63. This had never happened before in history. And it was interesting because the company that was making the bid on the stock realized the next day that they made a mistake and they were bidding way too much for the company. But at that point, it was too late for me, because my clearing firm, since I was in a debit situation, made me go down to the floor, close out all my positions, and I was in debt to them. And let me tell you, when you're a female on a floor of like 300 or 400 traders in all these different pits and stuff, and you had to crawl around like a puppy dog with your tail between your leg. It was the most humiliating experience in my life. I'm like, oh God, just let me out of this trade. Please don't rate me. Just give me a fair price to get out of this trade. Well, as the story would have it, so then the company realized that they really paid too much. At 63, they withdrew their bid, and the next day the stock dropped back down to the low 40s. Now, the interesting thing is that Larry McMillan, I'm sure all of you know his name because he's just one of the most fabulous stock and option analysts out there. He manages money. He's been in the business for 40 years, puts out a newsletter and so forth. He was originally on an ARB desk. And when that stock gapped up to 63, they put on a position locking in that price. And when it dropped the next day into the low 40s, or 2 days later, they got nailed on the downside. So I got nailed on the upside. Larry got nailed on the downside. We've been like fast friends ever since. It's like misery loves company. I'm like, this is such a screwed business. Why couldn't we reverse those bets? So that was that. Gulf Oil was the original company that was bidding for them. So, the clearing firm definitely wanted their money back, and they put me in touch with a trader in New York who needed somebody to run around and do all their orders on the Pacific Coast Stock Exchange, and that fellow's name of Morris Prop. And he was one of the first to have these supercomputers, that probably would fit in your wallet nowadays, okay? But back then he had a whole floor on one Battery Park Plaza just to house this computer. And what it would do is it would scan everything out of a line on the exchanges. And then, of course, he'd call me up, in the, a couple times a day. And it was like a love-hate relationship because he was a New York Jew whose grandfather invented Christmas tree lights, and like sailing all this, and here I am, the California blonde ditz here, So we were always like at each other's throat. But he'd be like, hey, something's out of line in that pit. Go in and sell some straddles. All I did on the Pacific Coast Stock Exchange was I was always short straddles. And the reason I was short straddles is because this was 1992, 82, 83. We were just starting in a bull market at that time. This was the very beginning of it. And all of Morris's models had the implied volatility way low, and it should have been much higher. So everything looked ridiculously out of line. So I'm running around with all these short straddle positions. And if you understand options and implied volatility, what happens if you're short the premium, when you get your graphs of the trading, it looks like a big frown. okay? So in other words, if the stock moves too far out this end, like city service, you're not happy. You're frowning because you're losing money, okay? So everybody on the Pacifico Stock Exchange was big frowns. That was their, which was great if nothing was happening because you could collect the premium. Well, just to give you an example of two other things, there was a case where we were short straddles on Thai Communication and Key Pharmaceuticals. And I don't know how many of you remember back in the days when there was a trading column in the Wall Street Journal, Heard on the Street, and there was somebody that was by the name of Steve Winan who was giving advance information as to what he was going to write. They were front running everything. It was inside information. Me, the lowly peon, a clerk on the exchange floor, I'm selling straddles to them, and lo and behold, the next day the stock gaps down 6 points because they wrote a negative article on it. So it wasn't too long before you learned very quickly that it is not a level playing field out there by any means. And unfortunately, I had to learn that the hard way. It was sort of like, damned if you do, damned if you don't. Morris, he's like, what? You went in and adjusted the position? You wuss, And then it's like, if I didn't adjust it, get in there and adjust the position, So it was like, I'm like, I finally had enough of the Pacifico Stock Exchange. It was nothing but bad memories to me. I'm still deeply in debt to my clearing firm. And I went out to the Philadelphia Stock Exchange. By happen chance, I actually went to New York and took a train down to Philadelphia and ran into some other people I had met on the Pacifico Stock Exchange. So I thought, well, I need to find another backer because Morris had somebody trading on the Pacifico Stock Exchange already, the Philadelphia Stock Exchange. And I ended up working for these team of 3 guys, and the main guy never said a word. He was like a master bridge player. He was an ex-physicist, and his name also was Jerry Mantell. And then, of course, there was Nate Bregman, who never traded but would always be piping on your shoulder, buy wholesale, sell retail. If they don't come for your inventory, mark it down and move it out the door. I'm like, we're not selling suitcases here, But like, this was the business. This was the business from their perspective. And so Jerry was one of the silent mentors who led by example. He would be there 2 hours before anybody else was at the clearing firm. He would scour everything. He would write out all his orders ahead of time because I'll tell you in a minute, the land of smiles here. So he would write out all his orders ahead of time, and then after the markets closed, he would sit there and he'd be there for another 2 hours. And he was this really quiet, round physicist who never said anything. And if you understand the dynamics of the trading pit, you got a bunch of, guys with, all pumped up there, and Jerry would be standing in the back of the pit, and the specialist would say, somebody would come in and want to buy 200 options, and Jerry would be like, sell 10, and everyone is like, well, sold, and Jerry's like, sell 10, so he never did the big size. And I found out like years later that he was the most consistently profitable trader on that exchange, and nobody would have ever guessed it. He was just silent strategy, not too big size, very calm. And what he would do is after the markets were closed, in those days you could see the book which listed all the options on the floor for the way out of the monies, the teenies as we would call them. And he would scour to see if there were any teenies that were on the book that he could buy dirt cheap. Now, keep in mind, these options are basically worthless, okay? But he would go and buy them up, and what would happen is, back in those days, this is now like, if you remember, Boski and Michael Milken and Greenmail and Blackmail and all these like crazy things happening, stocks would come to life. And they, of course, none of them really followed through and were takeovers, but the options would get really pumped up and the implied volatility would explode. But Jerry would have this little stash of worthless TDs in his back pocket, on his trading sheets there, and they would then allow him to sell the meaty options without any risk exposure, you see? So he was always thinking ahead about buying cheap insurance when nobody's paying around, thing around. So like, for example, everybody now thinks, oh, okay, buying out of the money puts, for a strategy in the S&Ps. No, you don't make your money on buying the out of the money puts, but what happens is if there is a flush, it allows you to then sell the big fat puts, that are at the money at the time with minimizing your risk. So he really taught me a lot in that regards just by watching him. So, I'm feeling pretty good because I'm doing all right, trading and stuff like that. And then one day they call me down on a Saturday morning, no less, into the clearing firm's office. That's not a good thing when your partners call you down and they're like, you're too big in this series. We told you don't get too big, because what happens in the pits, everybody was on the same side. It wasn't like the futures markets where there's bid, ask, and they're two-sided trading all day long. In the equity options, they want to come and buy them, and you're selling them, and you're selling them, and you have to scramble all the time and buy stock to hedge yourself. So it was kind of funny because I mentioned the difference between the Pacific Coast Stock Exchange and the the Philadelphia Stock Exchange. Pacific Coast Stock Exchange, they sold premium. You wanted everything to stay calm and well behaved. And on the Philadelphia Stock Exchange, it was the opposite. Everybody was long straddles and long the volatility. Well, that's good and bad, okay? You have to learn to trade stock very adeptly and constantly be trading the stock to adjust for the decay in your position, because otherwise you'll slowly bleed to death holding all this inventory. It just rots a little bit each day. So it forces you to become a very good stock trader. So everybody in the crowd pretty much ends up with the same positions on. And they'd say, all right, we told you that you had too many in this one series. And they would go through every single trade that traded on that Friday in my pit. Well, 20 traded here. How come you didn't do any, on that trade? Well, I was going to the bathroom. I don't know, it's like, and so they really were adamant about not getting too big. And that was a lesson that stuck with me for years later, because you learn that it's never a problem getting into a market, okay? It's never a problem getting into a stock, into an option, into futures. You can buy or sell as much as you want. It is always a problem getting out when you need to get out if you are too big. So that was a big lesson that I learned at that time. I never got on the right side of a takeover. I never got lucky with blackmail or green mail or anything like that. But I can tell you, one time I had my little charting service. I'm still updating these things by hand. And I always had my favorite pattern that I looked for that was sort of like a buy divergence, like a 10-day window buy divergence. And I was stuck on this 10-day window because somehow I had heard that the lunar cycles were 21 days, and this was like a half period of that, and it was like magic. I made so much money, buying call spreads or buying put spreads off of divergences off this, 10 to 11 day window. It was amazing. And so I saw this pattern in the soybeans. Now this is like back in 1987, okay, 1987, and it was July 1987. And I was just starting to dabble in a few other futures markets, and I'm like, this is my magic pattern. So I bought a bunch of call spreads, and then I started buying outright calls, and I'm like, well, I'll just buy some futures too. Well, nobody told me that beans are in a down seasonal then. It's harvest season, and you're not supposed to go long the market then. That's the worst time to go long the market. But, ignorance, I didn't know any better. It was just my little magic pattern. Well, as fate would have it, the Mississippi River flooded from these ridiculous rains over the next 2 days. It was totally random, okay? And it flooded so much. It was the biggest flood in like 30 years. They could not move the barges up and down that river to move those beans. And I'm just like, they're up limit. What do I do? They're up limit the next day. What do I do? They're up limit. It was like, so after that, I'm like, okay, I get it. brains has zero to do with trading. You know, you just got to get lucky once every couple years. I mean, it was just so random. So I had a really good year that year. I had paid off all my debts. I had bought a racehorse reject, you know, that like couldn't run. You know, I thought I'd get myself a horse because I'd always wanted one. And I was doing an internship at the barn because I had no clue what I was doing, and the horse was like 3 years old. He had no clue, you know, and I just thought I better just take some time off from the markets. And I'd usually call in the morning to the exchange, and there was one morning, and I called in, and my husband said, "Hey, you better come, you know, you better get home and watch the markets." And I had just set up a Quotron line for $1,000. I could have my own Quotron, which are the black screen and orange quotes, no charts, nothing like that, and another $1,000 to have my own data line. So I had my own home office there, you know, woohoo! And so I ran home, and I'm like, damn, you know, we just gave back the last 6 months of profits in 6 hours, and I'm like, I've been waiting for this, you know. So needless to say, I also gave back 6 months of profits in the next 6 hours because I started buying those S&P futures. I'm like, whoa, what's going on here? They were at a 20-point discount, and like, you know, so I bought some more on the close, and then you know, you all know what happened. They gapped up 40 handles the next day. And, you know, I'm like, it's a miracle, we're alive, you know. So, you know, and the problem with doing that is you get away averaging a loser, which is essentially what I did that fateful day. And it's the worst habit in the world you can ever have. It took me like 6 years to get that out of my system and just, you know, settle back in and stuff. And I got lucky once, but the sad thing is that I had all my money in the clearing firm. Every dime I have ever made was at First Options of Chicago, and you're not protected if you're an exchange member, like they have SIPC, or if it's at a bank account or something like that. Your money's not safe, trust me. So I could have lost everything with the $1 million loss at the time from the clearing firm, not the traders. And it was kind of a brutal time because I remember I went into the exchange the next day, and the biggest options trader there, who was a premium seller in the land of smiles, he was the lone frown, and he came in wearing a hockey mask that day to the exchange because he had lost 40 million. And I don't ever know what happened to him, but all I know is he came in wearing a hockey mask. I'm like, I'm going to stay in a different room, way away from this guy, you know. So after that, I pretty much started trading from my house. You know, I actually paid another $200 for charts on my Quotron. And then it wasn't long before a fellow came into the exchange selling a software program called Insight. That's a great name. And he was the first to write software for a home PC. Brilliant. And I had like an old 386, and I put this on there, and it was way cool because there were charts, multiple time frames, all these little indicators at the bottom, colors, you know, colors. I had been black screen with orange, you know, colors. I'm like, oh man, this is awesome. And I proceeded to lose money for the next 3 months. I'm like, you know, oh, well, aren't you supposed to sell when the stochastic gets up here and buy when it gets down here? And it's like, trust me, it doesn't work that way, you know. So that was a little bit of a learning experience. But after that, I was trading from home and you know, just calling my orders in by phone because we did not have internet, electronic execution, or anything like that. And I was getting pretty damn lonely after a couple years there. So I found out, I don't know how, about the MTA, which was just a short Greyhound bus ride up the turnpike there. You know, I wasn't about to drive into that city. So I started going up there for the monthly meetings and meeting these people who were all on the institutional side. Now, as a floor trader, I knew nothing about the institutional side, nor did I know anything about the retail side. You know, I think Larry Williams was starting to do conferences then, and Jake Bernstein, Jake the Snake, and, you know, all these classics out there. So I'm still clueless, you know, and I go up to these MTA meetings, And I met the most wonderful people, Arch Crawford, Dick Arms, you know, Bob Prechter, all these, Ralph Acampora, all these greats. And before you knew it, I was the librarian, okay? I served on the board for about 6 years, and I was in hog heaven because the library at the time was the largest technical library out there, and it had this bookcase of all these old, rare books, and I had the key. So I would sit there and, you know, spend a couple hours reading them and so forth, and I came across this manuscript which influenced my trading for the next 20, 30 years, called the Taylor Trading Technique, written by this guy, George Douglas Taylor, who had been a trader between the 30s, 40s, 50s, mostly a grain trader, but he also did stocks. And it was right up my alley because it was mostly discretionary tape reading tricks and so forth. And God knows, you know, I have it on my queue list to rewrite this book because it took me about 10 copies of this thing to finally get the main idea through my head. But the main idea is you're capturing the trend for the day. And if you get the trend for the day, there's usually a little bit of overnight follow through. So that is the most important thing. Is there a pattern where you can identify the trend for the day where the market's going from low to high or high to low? And we can play this game despite the fact that you've got 24-hour markets now, because either you can measure the trend for the day off the Asia opening, or you can measure the trend for the day off of our 7 a.m. Central Time or whatever metrics you want to use. Trust me, it works just fine, and you're always aware of the previous day's high or low. So that greatly influenced my thinking. Now, there was a fellow up there, Bob Perlman, who became really good friends with me. He was retired, and he kind of became my surrogate father, you know, because I hadn't spoken to my dad for a number of years. And Bob was on this mission. He had retired and sold his machine shop, and he was on this mission to investigate every trading methodology and thing out there because he wanted to do it. And his cousin at the time was the largest gold trader in the pits in New York, so he knew the nature of the game quite well, you know. And Bob would buy every system and investigate everything, and I was the lucky recipient of all his purchases. And you know, we could kind of wade through this stuff, what works, what doesn't. And I watched Bob over the next 3 years try out the seasonals for 3 to 4 months, try out this system for 3 to 4 months. And that's part of the journey that people don't realize when they're first starting to trade. It takes 3 years to investigate everything that's out there and see if it fits your style. And not only that, you can't just read a book or look at a system. You have to try trading it for 3 to 4 months to see if it works for your lifestyle and your comfort level and all this type of stuff. People far underestimate this part of the learning curve. It's not about technical analysis. It's about what style is going to speak to you. You're going to be a longer-term investor of stocks or an S&P day trader. And Bob is in his mid-60s at the time, and ultimately he decided that he did just fine day trading the S&Ps, and he didn't want to take risk home overnight. And this was still back in 1992, 93. They didn't really have the E-minis, but, you know, call down our orders to the floor and so forth. So Bob had purchased this system from Bob Duran. And Bob Duran published this Volatility Breakout system in 1991. And God bless him, because he is the only trader I have ever seen with total transparency. At the time he sold that system, he published every one of his trading statements for the last couple years, showing every trade. And if you look him up now, he still publishes every trade he makes on a daily basis to his blog. So now he's doing it with stocks, and you know, it's all he does, his system and so forth. But two things came out of that. First of all, when you are a floor trader on the floor, especially in the equity options, my job was to accommodate order flow. So the crowd comes in, the brokers come in, they want to buy because the market's going up. It's our job to sell to them. Of course, we have to mark the options up a little bit because we have to sell them so that we can scramble and go buy stock to hedge ourselves. Okay? But once a month, invariably, there would be one of those days where it goes up, You sell a little bit, you don't quite get it back, you don't quite get that stock hedge, and it go up a little bit more, and there's the temptation to average, you know, if you're a floor trader in the pit. And it only takes one day a month where you start doing that and it undoes the previous week of profits. And I was guilty of that as well, because you just never quite get that reaction to get it back, you know. So finally, with Bob Uran's Volatility Breakout system, I'm like, aha, I get it. You know, especially when you're not in the pit or the floor, it's like, oh, I'm supposed to buy and go with the market if there's range expansion and stuff. So it was a, you know, I like to exaggerate that a little bit, but it gave me the tools to put it in a logical, structural framework, which is what you need when you're processing data and you have all this information overload. You know, that's the beauty about if you're a market profile person and you can look at the initial balance, you know, or the first 30 minutes range or the first hourly's range or whatever it is. You have to find some way to chunk your data and add some type of structure to it. So at least if I'm buying high, which is what you're doing, chasing the market with a volatility breakout system, you know where your risk is, you know what the expectation is. I knew 66% of the time I could trade above that high the next day, and it gives you a statistical edge to hang your hat on as well. So that was number one. And then number two, eventually I had started managing money just the next year after that. That was a funny story, but Bob came and traded for me for a year. We had a little profit center with my my accounts that I was trading, and I invited Bob to handle, you know, trading this profit center, which was all the foreign markets. So we traded the JGBs, the Italian bonds, the FTSEs. Bob liked to stay up at night, so I'm like, great, that's your game. And I learned a lot from Bob about trading systems because, first of all, I am not a system trader. I'm a discretionary trader. I love the game of reading the tape. I'm really good at reading the tape and managing that way just from my years on the floor. You know, we didn't have charts. I'm having to watch the price. But Bob taught me two things. First of all, he said, if he lost money that day, he said, I did a great job. I followed my system. He said, the system lost money. I didn't lose money. You see, and there's a big difference because your job is to execute every trade. It's not your job to try and pick which trades are going to work and which aren't going to work. It doesn't work that way. You can't see where the big winners are coming from. And a volatility breakout system, for that matter, 90% of the mechanical systems out there are very dependent on capturing some of those fat tails. You know, trend following system, the outliers, these random big things. And with Bob's system, even though you could trade a futures market and it would make 2.5 trades per week, so if you're doing a portfolio of 12 markets or 16 markets, you're actually pretty busy making about 40 trades a week. Your average holding time is less than 24 hours. But guess what? Bob's system made 80% of its profits on about 4 to 5 days out of the year. You just don't know where they're coming from. So you're tied to that machine trading that system back in those days because it wasn't automated execution. So I got a good story for you. So he had sold this system to this group of German traders. They were over in Germany. They were trading about $10 million on it, and he was good friends with them. And they traded it pretty religiously, but they decided to take a day off because it was the World Soccer Cup Championships. And they wanted to watch the World Soccer Cup Champions. And guess what day that was? That was 1 out of the 4 days that year that made up like a ridiculous amount of profits, and they missed it all. So the other thing that Bob lectured at is if you are trading a system or a mechanical means, you have to take every entry. You don't get a second chance to enter the best trades. You have to take every entry. And I've heard Jerry Parker mention this before. He was probably the best turtle trader out of that group with his trend following and so forth. He says, I have no idea where the winners are going to come from. I mean, the greatest minds out there have no idea but they just know that it's a numbers game and you have to keep on putting yourself in that place. Now, if you enter that trade and you don't like it, or if it gives you the heebie-jeebies, or you know you're wrong right away, you can always get out of it. You can scratch it, take a small loss, do whatever you want. But you never get a chance to enter the best trades again. So that was another dynamic thing that he imparted. So after that, a couple more things that were interesting, and I just want to go into some like major outliers to let you know it is possible to still be alive after all this crap happens. One project that we did in 1992 was we were the first to use neural networks to train data, and I had gotten really into these 2-period rate of change, 3-period rate of change, 4-period rate of change, the first and second derivatives and so forth. And I had met this guy, Frank Key, and he was best friends with a guy whose son worked at NASA. I'm like, great, you know, I've always had to rely on everybody else to make sense of this stuff for me, because I can only process like down like to first grade level. And so we trained this neural net. It was pretty awesome. And neural networks, because there's a lot of talk about artificial intelligence now, everybody just thinks that these machines are running amok and taking over. Not so at all. Artificial intelligence is really dependent on the questions that you ask it, okay, as well as the data that you train it. And it's only as good as the data that you're training it on. Even if you're constantly retraining it, you're doing it with everybody else. So it's not quite the panacea that it might seem to be, but in this case, we were using the neural net as a pattern classifier. That's how they are to be used. They're not to give predictive things, they're just a pattern classifier. And what that means is you can say, for example, the post office uses artificial intelligence to read the letter A on your letter that you type, okay, or that you do by hand. Now there's got to be 5,000 ways that people write the letter A, but they have to train the, artificial intelligence to recognize all these A's, and then it's a pattern classifier and to say, this is an A, this is a B, and so forth. So we had this neural net, and we would say, okay, on a scale of 1 to 10, or 0 to 5, if it's going to be a big update, it's a 3. If it's a super big update, it's a 4. If it's a really big update, it's a 5. If it really can't tell and it's like little easy either way, it's going to be a 0. And same thing for the downside. Well, this sucker was so damn hot, I used to have to tell everybody I'm going to lock it up in a vault because it's like as good as gold, right? I mean, I had the people from the trading floor calling up to wanting to know what the neural net said that day. Okay, it's going to be up 3, so that gives them the confidence to bid a little bit more. But what would happen is, every once in a while, it would come up like with a +5 or a -5, but it would be totally wonky. It would be way off. I mean, it could say like +5, but it would be like the biggest downtrend day, and that would happen like maybe 1 out of every 20, 30 days. Well, that kind of destroys your confidence factor because you don't really have a stop when you're using this type of model. And what happened, it was like one of those aha moments, okay? Here's the aha moment. Traditional thinking for me at the time was the big moves come from buying something that's oversold and it rallies and you're a genius, or you're selling something that's overbought and it sells off, and that's where the big moves come from. Well, they do once in a while, but what the neural net was saying was, if you can imagine all these rates of change overlaid on top of each other, and let's say you've got a 10-period momentum that's way up here showing that there's a good broader trend in the market, and you have a little pullback on the 2 or 3-period rate of change, well, it's spitting out a 3 or 4, that it should be a nice buying opportunity, right? Makes total sense. Well, where it was coming out with these wonky readings was right when these little rates of change would start to cluster and they'd form a really narrow ball. And you can imagine if you had a low ADX and a lot of price bar overlap, or you've seen the consolidation periods, up one day, down one day, and all of a sudden you can draw a triangle. And what the neural net was saying was, right at that triangle point, it was spitting out this radical reading, except it couldn't predict the direction. So ultimately with that model, I used it to buy OEX straddles. And that was sort of like, okay, a shift in my thinking. And if you guys think about the current wisdom now, or the education from this market profile profile and volume distribution profiles, and how they talk about the big fat nodes that form, all the volume forms when you've fluctuated around a central price for a prolonged period. All right? Well, when you're moving out of that line, that sideways line, if you will, that's where you've really got a lot of opportunity. So it all ties in, and what you learn is that over the ages, there's a lot of different semantics for describing the same thing, whether you want to describe it in terms of momentum oscillators or volatility oscillators or market profile terminology. It all comes down to the exact same thing. So moving on, I had started managing money and got really blessed when everybody found out that the Pritzkers had given me money. I have no idea how that came about, but once the Pritzkers gave me money, I was like the hot thing on the block, and everybody wanted to give me money. So it was really never any problem for me growing my business as long as you delivered the returns. And pretty soon I had a couple people working for me, and I just want to mention a few radical experiences. Well, first of all, I'll tell you the first one. This was kind of an oddity. It was 1992, and I got a call from my broker one morning, and they're like, "Can't do business with you today." I'm like, "What did I do?" "What do you mean, can't do business?" "Nope, can't place any trades." 1992, the Chicago River had flooded. Who would have guessed? And the clearing firm that I did business with was in Chicago. They had to shut down the exchange for 2-3 days. They ended up setting up a shop out in Suburban. And the moral from that story was, I can't emphasize this enough. You need to have multiple accounts papered at different firms. It doesn't mean that you have to fund them. But if you're a professional, backup, backup, backup. Always, always, always. So another example, of course, I had major positions on when 9/11 hit. Guess what my biggest position was? Short euro dollars. Short euro dollars. And 9/11, of course euro dollars are going through the roof. I couldn't get a hold of my firm, which was Revco, 1 block away from the World Trade Center. I ended up having to call down to a desk in Memphis, Tennessee, to the people down there, because there was a Revco operation down there, to try to start getting myself out of this. So always, you hear about PFG, MF Global, all these things throughout the ages. You never know. Have multiple accounts papered. You can fund them instantly if you need to use them. You just never know whose software is going to get hacked into, whose servers are going to go down. We've seen issues with some of these firms in the past where their servers are a little bit compromised or slow. And it's never a problem getting in. It's when you have positions on and you need to get out. So now I am paranoid about backup. I have multiple data feeds. I had a satellite dish where I'm getting one data feed. I had another data feed coming in here. I had TradeStation. I had CQG. We had about $120 million under management. And I had built myself a hurricane office down in Florida. So I had this property, I built the house, I built the office. It had an underground propane tank, generators. My satellite dish out there. I am set, And at the time, I had a couple people working for me, an MIT intern. My house was like a zoo. And we knew this hurricane was coming, so we reduced our positions down a little bit. But everybody decided to camp out at my house because I was not near the coast, and I had all this backup, right? So this is what happens. The hurricane hits. Of course, all the power goes out. That was a given. Power stayed out for 10 days. Not fun when you needed to pump water for the toilets and take a shower and so forth. But that was okay because my office was up and running. So we're all huddled in this office for like the next 10 days. And I've got my computers up. They're all working. I've got quotes. I can see everything. My satellite dish is out there. It didn't get compromised in the hurricane. But you know what? All the cell towers blew over. The internet was down and the cell towers blew over. So I couldn't even call out. I'm watching the market trade, and I couldn't get out to make any execution if I had wanted to. So you just never know what's coming. So after that, I'm like, okay, I'll have a hurricane office up in Chicago. So if there's going to be a hurricane that hits Florida, I'll have the Chicago office. Redundancy, redundancy, redundancy. And I think that was a ploy by my now husband to get me up to Chicago. Oh, well, come up. And he by the way, he had executed my S&P orders since 1991. And so he's like, I'll set you up a hurricane office up here. Well, is that the line or what? So, so then I ended up spending more time up in Chicago. I had 2 people that worked for me up here. And just to give you a little bit more detail, you know how they say the worst is still yet to come, your biggest loss is still yet to come, okay? I just seem to be in the land of outliers, but always on the wrong side. For example, went down to Miami to see my daughter sing in a recital down there, and 2 days before I had put on some major ag positions. I had bought about 400 live hog futures. I even had some cows, and I'm walking through the airport on a Sunday evening, and you know those little kiosks that they have there? I glanced down, and there was a baby pig with a hypodermic needle in its mouth. I'm like, what the F? So it turns out swine flu. And I had just put on a major position in the hogs. I'm like, you gotta be kidding me. Now, the next 3 days, they are going down limit 3 days in a row, and I'm trying to get out of all these contracts, and the eggs are in chaos and stuff like that. I was like, really? Everything bad that's happened has happened to me. And then here's the coup de, the crown, yeah, right, the coup d'etat, yeah. So that's how bad it was. So it's a Friday afternoon. I was pretty bearish the market because the charts were just showing so much deterioration. And that Friday, I put on the biggest short position I've ever put on in my life. I had shorted 600 Russell futures and 600 S&P futures, and then the last hour I had to go to the dentist to get something fixed with my tooth. So I'm in the dentist chair, and Judd, who worked with me, is frantically like texting and ringing my phone, but I couldn't pick it up. Well, what happened is, as I'm sitting there in the dentist chair, I called Judd afterwards, and he goes, the spies, the S&Ps are not the futures, but the actual spiders. It's like, they're up 10 handles. I'm like, what? The market just closed really crappy. Well, that was the day that the Fed decided to come in and bail out Fannie Mae and Freddie Mac. And of course, the market opened up 40 handles against me on Sunday night. I'm like, you gotta be kidding me, Yeah, so that was like a nice $4 million loss right there. But, what you do in those cases is you have to recognize that these radical events also create a lot of opportunity because there's so much uncertainty and there's so much volatility. So the first thing you always do is you get smaller. So immediately, I took a hickey on half the position and got smaller so that we could think straight and clearly, and then trade, okay? Then trade. You can't trade when you're sitting there with this awful position on. You have to get out of it, and then you can always get back into it. So we actually ended up finishing that month up 3%. So I sat down and said, if I just sit there and I make back like $200,000 every day for the next 30 days, I'll make back the loss, whatever it was. And I made it back within 5 days. So you have to put it into something that's tangible, get smaller so that you are flexible and able to work again. Now I just want to give a shout out to 3 people who also were significant in my life, and unfortunately they've all passed. And but they all taught me wonderful things along the way. The first is Hank Prudent, who you know from the MTA. He's probably the greatest Wyckoff person in the world, was the greatest Wyckoff. He taught out at Golden Gate University. And I remember going to an MTA annual conference in 1991, and Hank was giving a talk there. And a talk, I think, was lent from some of Wyckoff's material, but it was called Doing Your Own Work in a Closed Room with No Windows and No Doors. Did you ever hear that from? Okay. In other words, you are your own best client always. And the thing is that if you're going to be a professional in this business, you have to do your own analysis. And not only that, you need to do it without distractions and biases that seep in from other sources. And this is exactly what Taylor said also. I have this Taylor book. I've gone through, God knows, 1 billion copies. He's like my Bible. He's like, you cannot listen to any of the tipsters, to this, to that, whatever. I've never had a TV in my office. I've never subscribed to anybody's, research. I have friends that do, and it's wonderful to see ideas, but you have to then make them your own. So if you're purchasing some analysis from somebody else and they show you a chart, don't take their word for it. Take their idea, and then you look at it and say, okay, that makes sense. I agree with that type of thing. But Hank made such an impression on me, and I realized how susceptible I am if somebody would say something. I remember one time there was a TV and these guys were talking about something, and I'm like, oh, now I'm damned if I do, damned if I don't. I have a position on that. Well, if everybody has a position on that, they're talking about it on TV, I should get out of it. One of these types of things, instead of just being able to read the market as it goes day by day and see it for itself. So Hank made a really strong impression on me there. Another person, he's still alive, thank goodness, but I got to travel with him in Australia when we were doing some seminars for Dow Jones and Telerate, and that's Perry Kaufman. And Perry Kaufman does some of the finest research I've ever seen out there. I know that his book nowadays is like this volume that's 800 pages long of every indicator and style out there, so it doesn't do you much good. Perry gave the thesis back in 1998 that as a market matures, and we're definitely in this environment now where these markets have been around for a long time, the noise level increases. And that's what people are struggling with nowadays. It used to be we could model stuff with a stop that was 2 ATRs, then it became 2.5 ATRs, then 3 ATRs, average true ranges, to stay out of the noise because the consolidations and bands. And then when the market tips its hand and breaks out, I'm sure all of you know this, it's a very efficient movement. You don't get the little retracement flags and continuation patterns that you might have gotten 20 years ago. So, it's like first come, first serve, and you're going to get your first pullback when 90% of the move is over, right? And then you start to get the rotation at a higher level. So when the market is trending, it is extremely efficient. Very, people are technically savvy. There's, instant, transmission of information. The bandwidth is, satisfactory and so forth. So I've watched Perry's comments on this just go to these increasing extremes over the last 15 years. And I'm sure you all know that feeling, when the bus leaves the station, it's a one-way ride. And then, I have to just give a shout out to Steve Moore too, because we had a research partnership for a number of years, and Steve taught me the best trade out there is a failed seasonal trade. All right? And the reason is because if the market's not doing something that it should be doing, there's a very strong reason why. So a seasonal could have worked 85% of the time for the last 20 years, but if the market starts doing something that it shouldn't be doing, you want to be on the right side of that, okay? You want to be in that direction. So for example, I remember it was in the early 1990s, and crude oil normally had a down seasonal period starting in January that went down to, actually I think this was like, maybe it was 2001, but suffice to say that year crude oil went from $16 to $35, and then over the next 6 years it went up to $145, and it was pretty much a one-way train. And it started with it totally defying the strongest down seasonal window that it had in its history, which was normally under pressure in January and February. So when there is an aberration aberration. You want to be on the right side of that aberration. If something's pushing the historical bands or extremes, you need to be positioned in the direction of that. And that is a very difficult thing for 99% of the people to do because A, there's a low sample size. You've never seen it before. It's a lot of uncertainty. You have no idea what's going on. You'll find out the news after the fact a year later, okay? It's a difficult thing to deal with unless you're trading a trend following system or some mechanical system. One of the smartest people I ever saw was Jeff Yoss. He was in the New Market Wizards book. He's in his chapters there. He's like by far smarter than me. And I watched him on the floor of the Pacific Coast Stock Exchange. Now, he was actually on the Philadelphia Stock Exchange. And everybody, there'd be these crazy little rumors and takeovers and stuff like that, and the crowd would sell the volatility because it was so pumped up at the time, and Jeff would be in there selling it too. So for example, if the implied volatility was like 22 to 28, that's its range, and it was 28, Jeff would be in there selling that implied volatility. But the next day, it might jump up to 32, and Jeff would walk into the pit and start buying the volatility and picking off all the traders. And you're like, wait a minute, he just sold it at 28, now he's buying at 32, what's up, okay? And sure enough, there'd be some more rumor and this and that, and the stock would do crazy stuff. And Jeff recognized the importance of that type of information, that the market is telling you something, just so important. Okay, I know I keep on getting the sign 5 minutes, and that was like 20 minutes ago, but I just got like one or two more things to tell you. One more person I want to give a shout out to, Mike Epstein. You know him from the MTA. He was like one of my best friends for 30 years, and I met him through the MTA, and he had started off on the stock exchange floor in the 1950s as a broker, and he had the most wonderful stories. I remember him in his later years. He had had diabetes and his eyes were gone, and I went to his house once and he's sitting there. Now this is like in 2007, and he couldn't see very well, so he had a big magnifying glass and just one screen with one chart, and it was the chart of the bonds. And I don't know if you remember the movement that they started making when real rates started going towards negative. It was unheard of. Again, it was one of these aberrations, and Mike said to me, he's like, I have no idea why they're doing this, and I have no idea where they're going, but I just know I'm supposed to be on this breakout of this triangle. And I couldn't do it, I couldn't do it. I'm like, what, rates like 3.5% and all this kind of stuff. It was unimaginable to me, but he was following the technicals and stuff like that. So a couple stories. He told me when he was on the trading floor, and he was a broker, and there was this one stock that had been like 2021 for like 6 months. It was really a real party back in those days, if your stock moved more than a point. And one day he had a client that told him, okay, if it trades above this price, I need you to buy 20,000 shares or whatever it was. So sure enough, it ticked there. All the other brokers were running to the phone, and Mike bought the 20,000 shares or whatever it was. And then the specialist came back in and ended up buying the shares from Mike a quarter point higher, or his client did, or whatever, selling them out. The story is that Mike's like, why did you do that? Why did you just take a quarter point like that? And the specialist pulled out of his pocket this wad of $100 bills. According to Mike, it was like this big type of thing. And he says to Mike, hold your hand out. And he put this wad of $100 bills in Mike's hand. He goes, now close your fingers around that and see what that feels like. Okay? In other words, it's not yours until it is locked in. So with that, I could go on and on and on, but I just have to reiterate, whatever you've seen, you've not seen half of it yet. The strangest things can happen, be it with your software, with your hardware, with your clearing firm, with the market you're trading. It is all about aberrations, and what that really says is about managing your risk. And if I hadn't learned that along the ways, I really wouldn't be here today, because I'm not the most anal retentive, conscientious person, but it was just through the good graces of a lot of people that mentored me along the way. And anyway, I have to say this. In all my trading history, I've just never seen such fabulous markets as we have today. And I know that everybody likes to whine on the volatility about these S&Ps. That's nonsense, because I can remember in 1991 or 92, the S&Ps had a 3-point range the average daily range was 3 points for like a 3-month period. There are markets, there are corn, there's bonds, there's currencies, there's crude. And if you look at the higher beta stocks, okay, there's fabulous movement in individual stocks. You know, don't get hung up on the fact that the S&Ps aren't doing so much, because that's just, it's a cyclical business. And truly, I mean, it's just every market has gifts, you know, every week. So with that, I'll look forward to talking to you guys more afterwards. Have fun. Remember, when you hear these guys talk tomorrow and the next day, everybody has something that you can take something from. Listen to them. If one thing strikes you as interesting or intriguing, take it home, massage that idea on the computer, make it your own, and that's so important nowadays. You have to take whatever somebody's talking about, a philosophy, a concept, an indicator, and you need to make it your own and put your own little twist on it and say, well, I wonder if I just added this filter, if I could increase its profitability a little bit. So have fun over the next 2 days. God bless this weather. It's awesome. Yeah. And I'll see you guys inside. Thanks, Jeanette.
All right, everyone, if you want to come inside and grab your book if you haven't already, Linda's going to head to the book signing table. I've moved it down here to the left, and she's going to sign your book for you. Fantastic.